certainty anymore. We're dealing with uncertainty. Here, math cannot exactly tell us what will happen. It can only tell us what might happen and how likely it is to happen. So, why does this happen? Like, why do some systems give certainty while others just don't? See, in deterministic systems, everything is controlled. Like, we know all variables and nothing random really interferes. But when we look at real world systems like financial markets, they do not behave like a simple calculation at all, because markets are driven by people, and we can all agree that people are not predictable. Sometimes people may act logically, sometimes they don't. And while making trading related decisions, they might panic or get greedy, or they might follow trends or even overreact. Plus, there's the constant flow of information, like through news reports, social media, and rumors. And there is another thing that not everyone may receive or react to the information at the same time. And then we have to include external events also, like political changes, global conflicts, or even natural disasters, which we know are totally uncertain and can instantly change outcomes. And even when nothing major is really happening, there are still random fluctuations which are caused by small trades and minor decisions. So now we have a system with thousands of participants. There's different information, different reactions, there's constant updates and randomness. And then we can't just expect it to be perfectly predictable. That just would not be realistic. So that is why instead of deterministic models, we used stochastic models. A stochastic system is one where randomness is an inherent part of the process, meaning even if you know the current state, you cannot exactly predict the next outcome. You can only describe it using probabilities. But this does not mean that the system is completely random. I mean, this might seem confusing, but here's the thing. There exists a middle ground where some structure exists, but it is mixed with a lot of randomness. So outcomes are not really fixed, but we can't say that they aren't chaotic either. So the key idea here is that markets are not completely random, but they are not completely predictable either. And that the space that is there in the between that we just discussed, the middle ground, is exactly where probability theory comes in. And it does not necessarily eliminate uncertainty, it kind of organizes it. And it gives us a way to say, here are the possible outcomes, and here is how likely each one of them is. And I think that is enough to start making decisions, even when there is uncertainty. That brings us to the concept of expected value. So, what is expected value really? It is the weighted average of all possible outcomes, where each outcome is multiplied by the probability of it happening. So instead of like asking, what will happen, we're instead asking, if I repeat this particular situation again and again, what would be the average outcome that I should expect over time? Mathematically, we write it as ex, which is equal to the summation of xi multiplied with pxi, where xi is an output and pxi is the probability of the occurrence of that output. The formula is visible on the screen. It just means that you take every possible outcome and multiply it by how likely it is, and then add everything together. Now, we would try to understand this with a simple example. Suppose you have a situation where there is a 50% chance of you winning 100 rupees, and there is a 50% chance of you losing 50 rupees. So if you were to calculate the expected value for it, you would multiply zero point 0.5 with 100, and then add the multiplication of zero point 0.5 and negative 50, which would be 50 minus 25, so it would give us 25 rupees. So what it actually means is that on average, every time we play this game, we are expected to earn 25 rupees. Not every time, this is very important, not every time, but on average over many repetitions. Because see, anything can happen in a single trial. We might win, we might lose, but when you repeat the same setup again and again, the randomness kind of starts to balance out, and the average becomes more stable and predictable. And this is the key idea behind expected value, that even though individual outcomes are uncertain, the long run average is not. Um, uh, so it is a long term concept. It does not guarantee that we will make money in a single attempt. It doesn't even guarantee that we'll make it in the next few steps. What it does tell us is that if we keep playing the same game under the same conditions over time, again and again, so over time, what will happen is the average result will move towards that expected value. Uh, Now, there is an important assumption which is hidden. It's that expected value calculations assume that the trials are independent and identically distributed. Independent basically means that the outcome of one trial does not affect the outcome of another. So what happens before would not change the possibility of what happens next. And identically distributed means that the structure of the system stays the same. Like the probability and the outcome do not change. In real world systems, these assumptions are not always true. Say for example, in real markets, outcomes are not completely independent. Past events can somewhat influence future behavior through things like trends or reactions, and the probability structure itself can change over time as new information comes in. So while expected value gives us a very powerful framework, we just need to be aware while applying it in real situations. That the underlying assumptions might not always hold perfectly. But okay, here's the catch though. You can actually lose more often than you win and still be profitable. Because see, we usually associate success with being right most of the time, but expected value shows us that this is not necessarily the case. We can understand this with the help of an example. So suppose you have a situation where you win 200 rupees with the probability of 30% and you lose 50 rupees with a probability of 70%. So at first glance, this does not look very appealing, because just by looking at the frequency, you might think that this is a bad deal. But let's calculate the expected value and find out. We get 0.3 multiplied by 200 minus 0.7 multiplied by 50, which gives us 25 rupees. So even though you lose 70% of the time, you still make money on average. Basically, success is now no longer about how often you win. It's about how much you gain when you win and how much you lose when you do lose, and combined with their probabilities as well. So a system where you win less frequently but gain more when you do can still be profitable as long as the expected value stays positive. This breaks a very common assumption, which is that a high win rate does not automatically mean success. So we could win 90% of the time and we could still overall lose money if our losses are large enough. And on the flip side, we could win only 30% of the time, like we did in our example right here. And we could still be profitable if our gains are significantly larger than our losses. This idea basically forces us to rethink what winning actually means. See, it's not about being right in individual cases, it's about having a system where over time the math kind of works in our favor. Now let's go a little deeper into this, because so far we have talked about outcomes in a very simplified way, like win or lose and profit or loss. But in real systems, outcomes are not just two possibilities. No, they actually follow something called distributions. So instead of thinking in terms of like one single outcome or even a few outcomes, we think in terms of a range of possible values and what is the frequency of each of the values occurring. So let's take a look at what is distribution. In simple terms, it is basically a way of describing how outcomes are spread out. Like if I repeat an experiment many times, so a distribution will tell us which outcome will happen more often, which ones are rare, and how everything is kind of arranged overall. So now, one of the most common distributions that you must have heard about is the normal distribution, also known as the bell curve. And a lot of natural processes follow this pattern. For example, things like heights of people, measurement errors, or exam scores, these kind of things often form this kind of shape. And in a bell curve, most of the values cluster around the average, And as you move away from the center, outcomes become less and less likely. So you get this very symmetric curve where extreme values are very rare and most observations are somewhere near the mean, as we can see in the given graph. And because this pattern appears so often in nature, it kind of becomes easy to assume that many systems behave this way. It is neat, it is also mathematically convenient, and it does give a very intuitive picture. Most of the times things are normal and extreme events are unlikely. But financial markets do not behave like a perfectly normal distribution. They might look somewhat similar at first glance, but when you study them more carefully, you might notice important differences. Like, in particular, financial returns often show something what we call fat tails, skewness, and excess kurtosis. So when we say fat tails, what we mean is that extreme events actually happen more often than we would expect them to if the system followed a normal distribution, that is. So, in a normal distribution, very large gains or very large losses are supposed to be extremely rare. But in markets, they happen more frequently than the model predicts. So, those tails of the distribution, the extreme ends, they are heavier or fatter than expected. And this has a huge implication because if you are using a model that assumes a normal distribution, it is possible that you might think that extreme events are almost impossible, which is not true. In reality, they're just unlikely. They are still very much possible, and they might be happening more often than your model suggests. They are possible, but it's just the thing that they are unlikely. Then there is skewness, which basically means that the distribution is not perfectly symmetric. So, as we know that in a normal distribution, the left side and the right sides are mirror images. But in real financial data, we might see that losses behave differently from gains. For example, large losses might be more frequent or more severe than large gains, which creates an imbalance in the distribution. Really. And then we have excess kurtosis, which is a way of describing how heavy the tails are and how sharply peaked the distribution is, compared to a normal curve. So, in simpler terms, it tells us that not only are the extreme events more common, but also the outcomes tend to cluster more tightly around the average most of the times, with occasional large jumps. So, when we put all of this together, we get a very different picture from the clean bell curve we're used to. Markets are not smooth. We know that they are not nicely behaved systems where extreme outcomes are negligible. Instead, they are systems where most of the times things do seem normal, but occasionally we might get large unexpected movements. So, if you assume that outcomes follow a normal distribution when they actually don't, you will underestimate great risk. You will believe that extreme losses are far less likely than they actually are, and that can be dangerous because it creates a false sense of security and it might have a big impact. So, the key takeaway here is that understanding the shape of the distribution is quite just as important as understanding the average outcome. And it is not enough to know what happens most of the time. We also need to understand what happens in the extremes because those rare events can have a very large impact on the overall system. So, as we can see, the first graph shows normal distribution, it is a bell curve. The second one displays fat tails, as we can see that the tails, they are broader. The next one here shows skewness, as it does not look symmetric, so it is not symmetric. And the last one shows kurtosis, where we can see that the peak is sharper. Okay, building on what we just discussed, we now know that expected value tells us the average outcome over time, but it really doesn't tell us how those outcomes are spread out. It does not tell us how smooth or how volatile the journey is going to be, and that is where variance comes in. So, while expected value answers the question like what happens on average, Variance kind of answers a different question, which is how much do these outcomes fluctuate around the average. So, in other words, even if we do know where things tend to end up, we still wouldn't know how wide the path is going to be without variance. And in real world systems, that difference matters a lot. Mathematically, variance is defined as the expected value of the squared differences between each outcome and the mean. So we are essentially measuring how far each outcome is from the average, and we are squaring the differences. So so everything stays positive, and then we're taking the average of those values, the formula for which is on the screen. But we don't really need to focus too much on the formula itself. It is the intuition that is more important. Variance, because variance is basically a measure of how spread out our results are. Okay, it's like imagine we have two different strategies, and both of them have the exact same expected values. So if we only look at the average outcome, they seem equally good, right? But the way they behave can be completely different. One strategy might give us like very small gains, small consistent gains, which could be very steady and very predictable. But the other strategy might give us large gains sometimes, and even large losses also. So the outcomes are much more spread out. So even though the average could be the same, even though the average is the same, the experience of following those two strategies could be very, very different. And that is where variance becomes important, because it kind of captures that difference. So, a low variance strategy means that our results stay closer to the average. Like it does not vary a lot from the average value. It has fewer surprises, smoother performance. And on the other hand, a high variance strategy means that our outcomes are more scattered. They vary a lot from the mean or average value, and they involve bigger ups and downs, and it has more unpredictability in short terms. So let's think about this from a practical perspective. Okay, if we are dealing with high variance, we are more likely to experience large drawdowns, like right. So like periods where our performance drops significantly before recovering. And these drawdowns, they are not just mathematical, they're also psychological, because they create pressure, they also create doubt, and they kind of test our ability to stick with the system. So here is a question for you all. Let me ask you something. If you face several losses in a row, even if you know that the system is profitable on average, but you still face several losses in a row, will you continue with it, or will you start questioning it? I think it is safe to say that you will start questioning it, right? That is exactly the challenge high variance creates. It doesn't just affect our outcomes, it also affects our behavior. And this leads to another important point, that high variance increases the risk of quitting early. Like, even if a strategy has a positive expected value, and even if the fluctuations aren't too large, many people would not want to stick around for a long enough time to actually realize what the average outcome is. They might exit too soon, and often, they might exit during a bad phase, and then they could never see the long term benefit. So, when we talk about risk, we're not just talking about losing money. We're also talking about variability, uncertainty in outcomes, and how difficult it becomes to stay consistent. And two systems can look identical on paper in terms of expected value, but in reality, one might be much harder to follow than the other because of its variance. Okay, so now let us connect everything we've been building so far, because this next idea kinds of ties the concept of expected value and variance together. And I assume you've probably heard about this before, the law of large numbers. And but even if you don't, that's okay, because we are going to talk about it. So, what does it actually mean in a practical sense? Well, formally, it says that as the number of trials increase, the sample average, what you actually observe, it starts to get closer and closer to the expected value. But let's not just leave it as a definition. Let's think about it actually. If you repeat the same probabilistic process again and again, what do you expect to happen to the average outcome? Does it A, stay random forever, or B, does it start stabilizing over time? Let us find out about it with the help of an example. So imagine I am flipping a coin, and if I flip it just once, what would be the average? I mean, it would either be 0% heads or 100% heads, right? That would be completely unreliable. We cannot trust that. And but if we flip it 5 times, maybe we get 4 heads and 1 tails. But that is still quite uneven. We still can't trust it. What if I flip it 100 times, or say 1,000 times? What do you think happens when what do you think will happen to the proportion of heads then? It would slowly move close to 50%. Not perfectly, definitely not instantly, but like gradually. And that is exactly what the law of large numbers is describing. So, here's a question for you all. If you have a system that has a positive expected value and you repeat it enough times, what do you think would happen to your average result? Think about it for a second. See, in theory, it should move towards that expected value, right? That is the whole idea. So, over many repetitions, the randomness kind of starts to cancel out and the underlying structures begins to show. But can we say that this means that if something has a positive expected value, you will start seeing profit very quickly? No, not necessarily. In fact, how many trials do you think is enough for this convergence to happen? You could say a random number like 10, 50, 100. The answer would still be that it depends. And this is where variance comes back into the picture. Variance is again playing a big role here. See, if the variance is low, outcomes are more stable, they are closer to the average. So convergence happens relatively faster. But if the variance is high, outcomes can fluctuate a lot, and convergence then will take much longer. So, even if the system is correct in the long run, the short term experience can still be very unpredictable and untrustable. Let's put it this way. If we're following a strategy with positive expected value, do you think it's possible to lose in the short term? Yes, it is actually possible to lose repeatedly for a while. Also, yes, you could lose, for the next 50 trials or something. So the question then comes to your mind, like, how long are you actually willing to stick with something, before you decide whether it works or not, before you decide to quit? That is actually the key nuisance here. The law of large number does not promise quick results. It does not guarantee that things will average out in the next few trials. It only says that as the number of trials becomes very large, the average will move towards the expected value. But that very large can be much larger than what we intuitively expect or what we thought of. You can still be doing everything correctly. You could be following a strategy with a positive expected value, and you could still experience losses for a significant period of time. And that can be very difficult to deal with because it does create doubt, and you start questioning the system, you start questioning the math, and you even start questioning your own decisions. So, let me just ask you one last thing. If you know the theory is sound, but the results in the short term do not reflect it, what do you trust? The short term outcomes or the long term logic? I would suggest you to trust the long term logic because that is what the law of large numbers is truly about. Okay, all right. Let's now take everything we've been discussing, uncertainty, probability, expected value, variance, and apply it to something very concrete. Like, how do prices actually move? One of the simplest ways to model price movement is by something called the random walk. And the idea behind it is surprisingly straightforward. It says that the next price is equal to the current price plus some random change. So, in other words, whatever happens next is just the current state plus a random shock. We can see the formula for it on the screen. Now, thinking about it for a second, if the prices change, if the changes in prices are driven by random shock, like, does it mean we can predict the next moment or just by looking at the past moments, or does it suggest that each step is not kind of independent of the previous one? See, the random walk model essentially suggests that price changes are random, at least in the short term, that is. And more importantly, it does suggest that past movements do not guarantee future movements. So, just because something went up yesterday, or even, for the past 5 days or 5 weeks, does that necessarily tell us what will happen tomorrow? No, not really. Here is a realistic question, okay? Have you ever looked at a chart and thought, it's been going up for a while, so it has to come down now? Or kind of the opposite, like, it's trending, so it will keep going. These are very natural thoughts. But the random walk model kind of challenges that intuition because it tells us that each step forward is influenced by completely new information and random factors, not just by what happened before. A good way to visualize this would be by imagining someone walking randomly, taking a step forward, then maybe sideways, and then backwards, who knows, without a clear pattern. That is. So, after a few steps, you might expect, you might see some direction, and then you but can you actually predict exactly where they'll be after the next step? What will their next step be? Can you exactly predict that after looking at them, looking walking them for a while? Probably not, and that is the essence of a random walk. So, now let us connect this to a bigger idea. This model is actually closely related to something called the efficient market hypothesis. The basic idea is that already reflect all available information. So when new information does arrive, prices adjust almost immediately, and those adjustments appear random because the information itself is rather unpredictable. Okay, now here is an important question. Okay, if markets were perfectly efficient, would it be possible to consistently outperform them using past data alone? The theory would suggest no, because all known information is already priced in, right? So any new moment is essentially a response to the new and unpredictable information. But now let's take a step back and be a bit more realistic. Are markets perfectly efficient? Probably not. There are delays, there are behavioral biases, there are a lot of inefficiencies. And this is where things get interesting because even though the random walk model suggests a high degree of randomness, in reality, the small statistical patterns or edges may still exist. So, here is another question for you all. If the moments are mostly random but not completely random, what does that mean for us? What does that really suggest? It would mean that we are operating in a system where prediction is extremely difficult, especially in the short term, but not necessarily impossible in a probabilistic sense. And this ties back to everything we've discussed earlier because we're not just trying to predict exact moments, we are also trying to identify situations where the next probabilities are slightly in our favor, even if the next step still has some randomness in it. So the key takeaway here would be that the random walk model reminds us that short-term moment can be very unpredictable, and that the past data does not guarantee future outcomes. But at the same time, it doesn't really mean that there is zero structure. Mean that there does exist structure that is subtle, it is noisy, and it needs to be approached carefully using probability rather than certainty. So just to bring everything together for a second, we started with uncertainty, which is the idea that we don't always get clear and fixed answers, and instead we have to deal with probabilities instead. So from there, we went to expected values, which tells us what happens on average over time. So it basically answers whether something is profitable in the long run. But then we saw that average alone is not enough, because variance tells us how much things do fluctuate, how smooth or how messy the journey actually is. And then distributions takes it a step forward by showing us how outcomes are spread out, especially the fact that extreme events can happen more often than we might expect. And finally, the law of large numbers ties it all together by explaining that these ideas really start to show up only when we repeat things enough times. And in the short term, things can kind of look completely random, but over time, the structure does become clearer. So, overall, it's not just about one concept doing all the work, it's all of them together. The probability helps us deal with uncertainty, and expected value tells us the direction. Variance tells us how rough the path is, and distribution tells us what kind of outcome we're actually dealing with. And once you start looking at the systems this way, it becomes less about predicting exact outcomes, and it becomes more about understanding how things behave over time. So okay, now I have a very fun mathematical game for you all. And it's you don't have to think very fundamentally, it's just you have to apply this one formula. I hope you remember that we talked about expected value, and we calculated the formula for the same, which was the summation of multiplication of outcomes with its probability. So the name of this game is, would you take this trade? You have to answer in either a yes or no. You could use the chat box to answer. uh, I suggest taking a pen and paper out and get your game face on, because what we would basically do is I would show on the screen some you earned X rupees at this probability, and you lose X rupees and you lose Y rupees at this probability. Now you have to calculate the outcome of the expected value. You have to think if you would take this trade or not. I hope you all participate, because I am really excited for this. So, our first trade is, would you take this trade? I see people answering yes in the this trade or not. Go step by calculate value denoted by E. So you would multiply the probability of winning, which is subtract multiplication of probability of losing with the outcome of losing, which would give you 24 rupees as the expected value. This basically means that on average you are expected to earn 24 rupees per trade. So let us go to the
Large drawdowns can exponentially lower your capital. And yeah, psychology, apart from mathematical factors, you have psychological factors. Even if you believe your strategy is a good strategy, you have backtested them, you believe it. Two, three consecutive losses, especially when you risk a higher percent of your capital, two, three consecutive losses can hit you psychologically that you may want to reconsider your strategy, even though when backtesting, you feel your strategy is a good strategy. So once don't just look at returns, they look at the drawdown also, because a bad drawdown, no matter how good the strategy is, your your trade is gone. So our goal here is not to eliminate drawdowns. We cannot eliminate drawdowns. It's a part of every. It's mathematically possible. You cannot. It's impossible to eliminate it, but we can hedge our positions in such a way that even if we have a bad luck initially, we get a really bad drawdown, we can manage it. So there are a few methods how we do it. Is position sizing. First is position sizing. We'll look at Kelly criterion and all in upcoming. There's a criteria formula called Kelly criterion that determines position sizing. So basically, if I need to explain position sizing in very simple terms, say you have a 100 rupees capital, you don't go in on the first trade with all the 100 rupees. You maybe put 10 rupees, 15 rupees, or 20 rupees. How to decide how much money to put? We'll look into it later. And second is risk control. If you're betting a higher capital of your money, if you're betting maybe say 50 or 60% of your money, you need to look into a strategy that gives a lower drawdown. If you are betting a small amount, you can go for a more riskier strategy. But if you're betting a large amount, you need to look into a strategy that gives a lower drawdown. Third is diversification. So out of your capital, 100 rupees of your capital, you can bet into multiple strategies. Say one strategy, you can have two consecutive drawdowns. But say you use four or five strategies, it's not possible. It's very, very unlikely that you get two or three consecutive drawdowns in all the four or five strategies together. So a good strategy is not just profitable. You should not just be profitable. You should survive the long run. So even if you make drawdowns in the initial period, you should stay long enough in the market to survive the long run. So that's how it's about. Yeah, and as I explained, position sizing, that if you risk too much, um, if you take higher risk and your luck is bad, you have a bad drawdown, your capital is wiped out. So yeah, I'll give you a question. This question explains drawdown. You start with 1 lakh rupees capital. You risk 25% of your capital. Risk 25% meaning you put 25,000 in. 25% of your capital per trade. So you will get a total of four trades, right? 25 to 4. You will stop trading if the capital follows 50,000 rupees and you have four trades. Two trades give plus 40% and two trades give minus 40%. So you have a 50% win rate, plus 40%, minus 40%. Order is unknown. Anything can happen. Which sequence gives the higher final capital? So this is not really hard. Sequence, say option A. You win first. You have 40% gain, 40% gain, and 40% loss, 40% loss. You make a loss. Yes, you do make a loss. You make about 29.44% loss. But in option B, you initially make a 40% loss and again you make a 40% loss. You fall below the threshold of 50,000, you stop earlier. That means this is the drawdown condition where you make huge losses initially and it falls below the threshold and you lose your mental strength and you start doubting yourself and you stop the trading. So option B is the bad drawdown condition we were talking about. Path depend. Any doubts so far? Anyone? I assume no. I cannot. So I assume no. Let's go on to path dependency. Path dependency is the order. So path dependency means that the order in which the returns affect your actual outcome, even if the overall strategy is the same. So even if you have the same RRR, the same win ratio, everything, all the conditions are same, you can still make money in different kinds of ways. For example, the graph. So you have Mark and Susan, both choose the same strategy, but still, there in the long run it might converge, but in the shorter run, you can see the difference between the blue line and the orange line. There's a huge difference. The longer run, yes, but you need to stay, even though it's expected to converge in the longer run. You need to be able to maintain. You need to stay in the game until the long run to make your profits. So part dependency, two traders can follow the exact same system with the exact same win rate, exact same payoff, exact same RRR, but end up with very different results depending on how wins and losses are distributed over time. This happens because trading is not just about total returns, it's about how capital changes step by step. Okay. In theory, if you look at averages, order may seem irrelevant. Yes. Now we were talking about expected value, we are talking about RRR. We might think that order is irrelevant. It doesn't really matter. But in real trading, your capital is constantly changing. So every trade you take, every gain you make or your loss you make, your overall trade amount is constantly changing. You make if initially you get losses, then you might not able to compound the profit as effectively as getting gains initially like Mark did. Okay, this makes the sequence of outcomes very important. So path dependency is very simple terms is the path the capital total capital follows as you have seen in the um, graph over here. So the biggest impact of path dependency is on drawdowns and recovery. If you face losses early, your capital drops, and even if you get a winning trade later, these gains are applied to a smaller base. This makes recovery slower and harder. On the other hand, if you get wins early, your capital grows first, and even after losses, you may still end up in a better position. So, though we cannot what do you call predict the path it's going to take, though we cannot change it, but there are certainly a few ways by which we can be better prepared for it and can analyze on which trade to take and which trade not to take. We'll look into that further. So that's why what quants do, they don't rely on a single outcome. They use as many, they develop a simulation to simulate as many paths as possible. And if the average, since they conduct the same trade multiple number of times, on an average, if the trade is profitable, they will take the trade. So this simulation is called the Monte Carlo simulation. Have any of you heard about it? Okay, since it's a little bit deeper, I'll just assume you don't know. I will start with the very basics. So to handle drawdowns, what one uses a Monte Carlo simulation, where the same set of trades is conducted multiple times. As you can look in this graph, maybe 1,000, 10,000 times, and each time is plotted. So they conduct the same set of trades, the same very same trade, all the same categories multiple times, and they plot a graph out of it. This is called Monte Carlo simulation. This helps us visualize how widely the result can vary, even though the strategy itself doesn't change. Some paths look smooth, some are volatile, some may fail completely. We'll see more about this, but if you look at the graph over here, you can see it's the same strategy. All this line, same strategy. You can see a red line. That's our best case scenario. The green is the best case scenario. The red is the worst case scenario. On an average, yes, if you plot a line to the average, this trade setup is profitable. But again, on the part dependency, you may even end up in a loss. Like it depends on the red line. Though it is rare, it is definitely possible. Again, very basic one, which is more dangerous. A bad strategy with small losses or a good strategy with very bad starting sequence. B is more dangerous because if you have a very good starting sequence, it's a default mindset, a psychological factor that in the beginning it's broken, maybe it's not right, maybe I have to change something. So a very bad impact our trade. So let's go more into Monte Carlo simulations. Monte Carlo simulation is used to generate many possible outcomes for the same trading strategy by changing the order of trades. So what they do basically, same trades, same win rate, same RRR, simulate it. They use code to simulate it. We'll look at. I have the code of this, so stay tuned until the end. We will look into the code as well. So they are the same trade, same RRR, same win rate, and they um, simulate all possible strategies. And based on this, they can make decisions on whether this trade is a good trade or not. The strategy doesn't change, the win rate doesn't change, same number of trades, but the sequence is shuffled. Say in one, it's run by the computer and they use random variables. So what is it? What it is in certain cases they consider four or five consecutive wins, then losses, or in certain cases they consider consecutive losses, then wins. Based on this, we'll get a bush type of shape thin in the end, and as it goes further along the x-axis, it keeps increasing because the winning trades compound more effectively, and the losing trades compound less effectively. So you get this kind of shape. When you look at multiple simulated paths, you see a wide range of results. Some paths grow smoothly, some go through deep drawdowns, and some may even perform poorly for long periods before recovering. This variation exists even though the underlying strategy is identical. Same strategy, but different variations. So relying on one good-looking backtest is misleading because it ignores all other possible paths that could occur. So more deeper into Monte Carlo. Monte Carlo helps you understand the range of outcomes, not just the average. It shows the best case, worst case, and typical scenarios for your strategy. This is important because even a strategy with positive expectancy can go through very bad periods. So if say like we already spoke about, in the longer run, say your strategy expected value is positive, you are expected to make money, profit in the longer run. But a long drawdown periods can hit your strategy so bad that you may abandon your strategy. So using Monte Carlo simulation, you get a better idea of what the strategy is and how it's expected to behave. It also directly connects to risk of ruin. So we'll discuss about risk of ruin further. And some simulated paths may recover, while others may fall so deeply that recovery becomes unlikely or impossible. This tells you whether your strategy is not profitable on average, but also survival under the worst case condition. Your goal is not just to make money; it is to ensure you don't get wiped out before the edge plays out. So it's simple. Um, yes, you need to make a profit, but you need to stay long enough in the game so that your profit starts showing up. That's good. A simple question again. You run a backtest and get a smooth equity curve with strong returns. Does this mean your strategy is safe to trade? Why or why not? Can one of you answer this based on anything I've got so far? You can use the chat box if you're not chat box if you're not comfortable speaking. Any, anyone? Anyone? Okay, we'll go on. Yeah, right. So you run a backtest, get a smooth equity curve with strong returns. Does this mean your strategy is safe to trade? Why or why not? No, this is just one possible path. Other path may include deep drawdowns, long losing streaks, and delayed profits. So you should always run the Monte Carlo simulation, else you're ignoring risk. Run the simulation. Based on the simulation, you can go and make further. You can go further. So backtest shows what can happen once, but the Monte Carlo simulation shows what happens when you do the same trade many times. So we'll come to risk of ruin now. Any doubts for anyone so far? Okay, let's move on. Yeah. So risk of ruin. Risk of ruin is the probability that your capital falls to a level where you can no longer continue trading, effectively wiping it out. So say that you have 100 rupees to trade, but you have a constraint that if it falls below 70 rupees or 50 rupees, you don't want to continue this trade, you don't want to take any more risk. So this 50 rupees mark is called the ruin mark. And the probability that it falls below the ruin mark is called risk of ruin. Uh, it does not require a bad strategy, like I told. It does not require a bad strategy, but bad luck can definitely get you there, and you need to um, hedge your position in such way that even with bad luck, you do not go to risk of ruin. Again, the ways to do it are um, position sizing and diversification. We'll talk about it later, but yeah, it can happen even with a profitable system if losses occur in unfavorable sequence or if risk is too high. Say your position is too high. Out of 100 rupees of your capital, you choose to bet 60 or 70 rupees in one trade, and the trade has a win rate of 50%. Two consecutive trades can wipe out. Yeah, you have less than 50 rupees of the capital remaining. And getting two consecutive losses is not a rare event at all. It's just equivalent to you flip two tosses and you get heads both the time or you get tails both the time, which is not rare at all. It happens many times. So it's not a rare event, and it is a measurable outcome based on your strategy and risk-taking behavior. So that's where it comes into play. And in simple terms, every trade carries a chance of loss. A sequence of losses can compound quickly. You make a 50% loss from a 100 rupees capital, you make a 50% loss. You get it come to 75 rupees. You make a 50% loss again, you have only 37.5 rupees. So two losses, which is not rare at all, can blow out the capital over 60% of your capital. So if your losses are large relative to your capital, you may reach a point where recovery is practically impossible. So from 100 you make a 50% loss, again a 50% loss. You have only 25 rupees left, 75 rupees. You have blown up 75 rupees because of you didn't choose your positions smartly. From this 25 rupees, the recovering, forget about profit, just to reach the break-even point, recovering to 100 rupees, from this point, you need a 300% return, which is really hard. I mean, even if you have a really good luck, on an average, it's really hard to get it, and most people usually quit. The ruin is driven by interaction of compounding losses and unfavorable sequences of trade. When losses occur early or in clusters, your capital drops quickly and all future trades operate on a reduced base. Even if wins come later, they are applied to a smaller capital, making recovery much slower. Like we already said, instead of 100, if you win 50% when you're on 100 rupees, you make 150. But same if you're on 25 rupees, even if you win a trade, you make a 50% profit. You get from 25, you only go to 37.5. You only make a 12.5 rupees profit. But on the same, when you have a 100 rupees capital, you make a 50% profit. So even if you win, if you lose initially, even if you win later, you will not be able to recover your capital that easily. This creates a situation where the same strategy can either survive or fail depending purely on how outcomes are ordered over time. The key issue is not how much you lose, but when you lose. Early drawdowns, early losses, and consecutive losses, both early and consecutive losses, increase the probability of hitting critically low capital levels before strategies edges come out of play. Like I said, early losses, early you lose, and even if you win later, you will not able to the same amount later. You will not be able to get to your initial capital. You'll run into a loss. This is why risk of ruin is not about average performance, but it's about whether your capital can withstand the worst realistic path of return without collapsing. One question I'll like to give you this question. Then after we'll take a minute break. If you want to go drink water or whatever, we'll take a minute break. But one question: two traders use the same profitable strategy, same win rate, same RRR, same expectancy. Both start with a 1 lakh capital. Trader A risks 2 rupees per trade and trader B risks 10 rupees per trade. So risk 2 rupees is trader A use 2000 rupees. 2% of 1 lakh is 2000 rupees per trade. B uses 10,000 rupees per trade. Both take the same sequence of trades and both complete all the trades. Who has a higher probability of ending up with a very low capital near ruin and why? Anyone wants to take a attempt? Anyone want to attempt? Okay, I see no hands. Okay, we'll just go ahead. Yes. So trader B. Trader B risks more capital per trade, and each loss has a bigger impact. Say he loses the first two continuous trades. Um, he traded with 10,000 rupees. He loses the first trade, 50% of his capital is gone. He has 5,000 rupees. He loses the second trade, again 50% is gone. So he's lost 7,500 rupees in total. But trader B, even if he loses his entire betting capital, the initial betting capital, he loses only 2,000 rupees. So trader A, he takes lesser risks. So in the worst case scenario, he makes lesser losses, but on the longer run, if on the average case, trader B, since he takes more risks, he is more likely to make more money at the same time, more likely to lose all his money. So we'll take it's 10:14. We'll come back at 10:15. We'll take a 1 minute break. Hope all of you are back. We'll continue. We'll go on, right? Yes. So we'll go on to the next. So this is one of the most important topics, position sizing. Okay. So position sizing is the capital you allocate to each trade. The previous example, trader A risks 2% per trade, trader B risks 10% of the trade. These 2% and the 10% are the size of the positions they initially make. This is what position sizing is. So position sizing is how much of your capital you allocate to each trade. It determines the actual impact of every win or every loss on a portfolio. So the higher you invest in each trade, the more loss you make. At the same time, the more profit you make. Two traders can follow the exact same strategy with identical entry and exit, yet end up with a very different results purely because of the size that trade, because they size their trades differently. So even if you have the same strategy, everything is similar. Your risk-taking capacity at the end determines your output, and uh, you need to find this position. There's an important formula called Kelly criterion, like I told before. It helps us to identify the best. position we can take given the constraints, the best position we can take so that we are profit the highest, we make the highest profit in the long term. We'll get to that. In trading, you cannot control whether the trade wins or loses, but you can control how much you risk on each trade. This shifts the focus from prediction to risk management. By deciding your position size in advance, you can define your maximum loss per trade, which helps avoid large unexpected drops in capital and keeps your strategy consistent over time. So in position sizing, we have different types of position sizing. First is fixed position sizing. Say you have a 10 lakh capital. You fix it that you're going to make maybe take 2 lakh or 2,50,000. You fix it or 1 lakh or whatever. You fix the size of your position. Next is percentage based position sizing. Say you maybe take a 10% or a 15% of your total capital. So the first trade, say 10% out of 10 lakh, you bet 5 lakh on your first trade. You invest 5 lakh on your first trade. Say you make a loss on it. You make a 50% loss on it. Say you make a 50% loss on it. Out of 1 lakh, your 50,000 is wiped out. So now you have 50,000 of the trade plus 9 lakh you didn't use. So you have only 9 lakh 50,000. The same percentage, 10% you used earlier. You again use 10% this time. You use 95,000 rupees, and this keeps going on. Percentage remains constant, but the trades, the amount you invest, your position size keeps changing along with the profit or the loss you make. This is a much better strategy than fixed position because um, if you make losses, you can reduce your risk by effectively cutting down on the amount of the position, which you can't do in fixed position sizing. Third is volatility based position sizing. This depends on the market conditions, how volatile the market is, and volatility and optimal F position sizing. These are a little bit complex topics. And Kelly criterion based position sizing. So this depends on your um, probability of winning the trade, the risk to reward to risk ratio. If you have to use the reward to risk ratio, we'll get into it. So position sizing is, yeah, it links to all the previous topics we have covered, like drawdown, risk of ruin, and path dependency. A larger size increases the impact of losing streak and makes bad sequences more damaging. So, say you risk a very high amount, say you risk 50% of your trades. Early drawdowns can make you lose a huge amount of your capital. So that's what a larger position size. It makes you more vulnerable to drawdowns, and you can lose higher amount of a trade. But at the same time, a very small position size, it causes you don't make a lot of loss, but again, yeah, you don't make a lot of profit in the long run too. So position sizing is not about just about trade size. It is about controlling how your entire system behaves over time. A common approach is to risk a small percentage of capital per trade, which automatically adjusts the position size as capital changes. So this is the position. This basically is the position, like we have seen here, the position percentage-based position sizing. When capital grows, position size automatically increases. Since the percentage remains constant, but the capital grows. Percentage remains constant, capital grows, but the size, the amount, if the capital grows, the amount you invest per trade goes higher. If you are in a loss, then the amount you invest per trade goes lower. This is a really good strategy, the percentage based position pricing. And when capital falls, position size decreases, protecting the account from further damage. This creates a natural stabilizing effect on the trading performance. The key idea is consistency. It's very important. You should always remain consistent. A well-sized strategy may grow slower in the short term, but it avoids large drawdowns and reduces the chance of failure. Over time, this leads to a more reliable and sustainable performance, which is far more important than chasing high but unstable returns. Now we get to Kelly criterion. It's a very important, very important formula. Um, so this Kelly criterion, it determines the optimal fraction of capital to risk per trade in order to maximize long-term growth. This is the graph. You can see the graph. We'll like say it. So say you have a 100 rupees capital, you risk 50. Say you have a 100 rupees capital, and each trade you make, your risk to reward ratio is 1:1. So you can lose 50% of your capital, and you can make 50%. So say you risk all 100 rupees, 100 rupees at once. Yes, of course, if you win, your capital goes to 200. If you lose, you go to zero, you're out of the game. Say you take a very small, say you take only 2 or 3 or 5%. You lose, your 5 rupees is gone. If you win, then it goes to you get 5 rupees extra, your size goes to 105 rupees. So this is more safer, but um, it's very slow. It has a very slow compounding effect. So Kelly criterion is a formula that helps you uh, find the best bet so that you can also get avoid the risk of large drawdowns, and you can also have good amount of returns. That's what criterion it tries to find a balance between growth and risk. It tells you how aggressively you should bet based on your edge instead of choosing an arbitrary percentage. Instead of choosing a random percentage, given the constraint, you can find the amount you should be betting. It is built on the idea that if you have a statistical edge, there exists an optimal size that grows your capital the fastest over time. If you bet less than this, the growth is slower. If you bet more, risk increases sharply and drawdown becomes severe. So Kelly criterion is not about maximizing returns per trade. It's about maximizing compounded growth over many trades. So here's the Kelly criterion formula. F star is the fraction of capital to risk. And P is the probability of winning, Q is 1 minus P, the probability of losing, and B is the reward to risk ratio. Very careful, it's not the risk to reward ratio, it's the opposite, reward to risk ratio. This formula directly combines with win rate and payoff in a single number that tests how much to bet. We'll look into an example for this. If the result is positive, you have an edge and should risk that fraction of your capital. If it's zero or negative, the strategy has no edge and should not be traded. So this Kelly criterion, like Navya gave you many questions, whether you should take this trade or whether you shouldn't. You can use this formula. If you get a positive value, it tells the percentage of your total capital. You should bet on this trade. If it gives a zero value, that means you make no profit, no loss. But you need that means you shouldn't. The ideal case, you shouldn't bet your money. If it makes a negative, if it gives you a negative value, that means you should completely avoid this, and you're not going to make money out of it. So in practice, what this Kelly criterion is a really important formula. It's not just used by us; it's used by large hedge funds as well. And in practice, when they are trading, they don't use the full Kelly's F star, the entire amount. But in practice, to again cut down on large drawdowns, they do not use a full Kelly. They use half Kelly or a quarter Kelly. So half Kelly is F star by 2 and quarter Kelly is F star by 4. Or they use 10%, whatever. That depends on them. But in practice, they don't always use a full Kelly to reduce the risk from drawdowns. Okay, this is a question based on Kelly criterion. I mean, if possible, try to answer. You are trading a strategy with a probability of winning 60%. On each win, you gain 2x of what you risk. On each loss, you lose your entire risk amount. You have a 10,000 rupees capital, sorry, 10 lakh rupees capital. What fraction of your capital should you risk per trade to maximum long term growth? Anyone wants to you can take a minute. You need to put your pen on the paper. You can't do it. I mean, it's really difficult to do it in your mind. So put your pen on paper, take a minute, and come up with an answer. Everyone is trying, right? It'll take a while. Take a minute to come up with the answer. Any answers here? Anyone? Okay, I'll go into it. Okay. So, what fraction of your capital should you risk per trade to maximize long-term growth? You need to use the Kelly criterion here. Here it is. Your probability of winning is 60%, which means P is equal to 0.6. Q, 1 minus P is equal to 0.4. B is your reward to risk ratio. So, as it's mentioned over here, you gain 2x, but you lose your risk amount, which is 1. 2 is to 1 is the reward to risk ratio, which is 2 by 1 is 2. You use the formula 2 into 0.6 minus 0.4 by 2. So here it is 40%. So to minimize the risk, not minimize, but to optimize between the risk and your growth, the ideal case that you should bet is 40% of your capital, which is 4 lakh rupees. So a follow-up question, would you actually risk 40% in real trading? Answer is no, because high drawdowns, if you have a bad luck in starting, high drawdowns can cause your capital to crash bad. So in real trading, I mean, yes, this really optimizes between risks and growth. But in real trading, you do not want to, you want to go in a little bit on the safer side. So they usually use half a Kelly. Half a Kelly or quarter Kelly is more often used. So they use half Kelly, maybe 20% or 10% of capital, but 20% most likely. So max growth is not equal to safe growth. If you go for the max growth condition, yes, you have a chance of really good growth, faster growth, but there's also very high risk. Safe growth, yes, you of course you don't make as much as money, but you're much more stable. Your curve is much more stable. So before we get to the summary, any doubts so far? Anyone? Any doubts? Okay, I see no hands. I assume no. Okay, summary. So, if you haven't able to catch up so far, or if you haven't been paying attention, this is the final. In one slide, I'll just summarize everything that I've thought so far. Okay. In trading, every decision starts with structuring trades using the risk to reward ratio, but profitability is not determined by this alone. It depends on how win rate and payoff interact, which is captured through expectancy, the average outcome per trade. So, win rate, risk reward ratio, they interact with expectancy, and all this together gives you the profit. This leads to the concept of positive versus negative expected value, where only strategies with a positive edge can make money over time. If you have a negative expected value, maybe you're lucky in starting, you can make money, two, three trades, you can make money, but on the longer run, when you make multiple trades, maybe 100,000 trades, you're going to make a loss. Where only strategies with a positive edge can make money over time. However, even profitable strategies go through drawdowns, and path dependency of returns means the sequence of wins and losses affects both capital and behavior. Since one backtest shows only one outcome, Monte Carlo simulations reveal the range of possible paths, including worst case scenarios, which brings in the idea of risk of ruin. So you backtest a strategy, you only see one possible outcome. But Monte Carlo simulations, you can see your best case scenario with your worst case, average, all possible simulations. So Monte Carlo simulations, it's good that you run it and you be ready for everything. Uh, this simulation brings out the idea of risk of ruin, the possibility of losing so much capital that recovery becomes impossible. Not impossible, but very likely that you're not going to recover. To control this, traders use position sizing. Position sizing is the amount of the total capital to risk per trade. Finally, the Kelly criterion provides a mathematical way to determine the optimal fraction to risk for maximum long-term growth. So Kelly criterion determines the position sizing. Though in practice it is often reduced to manage risk. They use half or quarter Kelly in practice to manage risk. Together, these concepts form a complete framework, not just how to make money, but how to manage uncertainty, survive losses, and grow capital consistently over time. And additional topic which we cannot cover in today's session because it's a little more advanced, will require a lot of time to go. But additional topics, if you are interested in this particular stream, if you want anywhere in quant related type, additional topic how you can proceed is you can learn more about volatility and correlation. So volatility, as we spoke about this, it measures how much markets fluctuate. In correlations, it measures how assets move together. Can have a positive or negative correlation. If you have two assets, uh, say asset X goes up, when asset Y goes up, you have a positive correlation. When asset X is inversely proportional to asset Y, they behave inversely, you have a negative correlation, you can use this. And apart from this, you have strategies. So strategies of making money. Here we just spoke about risk reward ratio, but there are strategies Here, statistical arbitrage strategy, mean reversion, and momentum. Statistical arbitrages, as Navya told about, markets aren't always perfectly efficient. So sometimes you might have some data which hasn't reflected yet on the market. So if you have this data in advance, you can use your position. You know what might happen in the future. You can use this as your advantage to make money. Mean reversion is a strategy called mean reversion, which tells us that in the long run, if you have a stock price and you usually see the graph and you also plot the mean of it, mean of all stock prices, in the long run, the price of the stock always tends to converge near its mean. Momentum. What momentum tells is if a stock price is going up, it tends to go up. And if the stock price is going down, it tends to go up, go down. Like the physics of momentum is similar. Factor models like value, size, momentum, they explain returns, optimization techniques, portfolio allocation, risk metrics, value at risk, VAR, conditional VAR, and further, if you want to go further, you can go to time series modeling, regime detection, whether it's a volatile market, sideways market, and these are the various other topics. You can learn further if you're really interested in this topic. So thank you for staying with me. And yeah, one final thing. I have a simulation for you of Monte Carlo simulation. I have coded it down. I'll just present it. Give me a minute. I'll open it. I hope you can see my screen. Yeah. So this is the Monte Carlo simulation we spoke about. So this is a basic, very basic Python code for it. Firstly I import the basic random function and matplotlib for plotting the graphs and numpy for array functions. And then I initialize the initial capital to 1 lakh rupees, win rate to 45%, risk to reward to risk ratio as 2, and say we take 50 trades and we want to perform 50 simulations on how each trade will go. So it's here risk levels. So let me take three risk levels. 0 point risk level is the amount you bet per trade. Say 2%, 5%, and 15%. 0.02, 0.05, and 0.15. So here is a very simple Python code. Okay, and when we run this, you can so what it does is it for each trade there's a 45% chance that the trade is we win the trade, 55% we lose. For each trade it simulates whether the trade is for each trade the trade is going to win or trade is going to lose, and it for 50 trades, and it runs 50 such simulations to plot the graph at the very end. So say we risk 5% per trade, or let's go with first. We risk 2% per trade. So here we have the 2%, which start with 1 lakh rupees, and we make 1 lakh 39,000 1 lakh 39,933. It's the average. On an average, we make 1 lakh 39,933. But here, as you can look in the graph, even though if you look into the trade, it's if Navya would have asked you the same question, you might have told him, yes, I would take this trade. But if you look into the graph, yes, there are certain paths where you make a really good amount of profit, over 100%, 120% of the profit. You even lose in a few paths. You even lose money. You make. You can see this there's a green line over here, where you're ending up with about 80,000 rupees. So it's 20% loss for you. So with 2% on an average, you make about 40% gain, but you can make higher and lower. Similarly with 5%. Average you make 160%, almost 160%, but as you can see in the graph, you can make about 700% as well, and you can lose a lot of the capital. And third, here you have 15%. Again, in 15% you make about in 50 trades you make about 850%, considering the 45% win rate in ideal in real world cases. This just for the experiment I have taken an example. It's not very realistic, but yeah, you in 15% you get a 841% risk, but yeah, you can make a profit, you can make a loss as well. Higher the risk per trade you take, the higher profit you make, the higher the loss also average increases, but there are more likely that you make a loss. So that's it for today. If any one of you want to take a photo of the code, let me. Yeah, if anyone you want to take a screenshot or something, you can take. Yeah. So yeah, that's it from my side for today's session. Any first of all, before we end it, any doubts anyone has? Raise your hands or use the chat box or speak up. Anything? Anyone? Mm, okay. Since I see no response, I assume no. So that's it from my side for today's session. Thank you all for joining. Yeah. Yeah. Please do fill in the attendance form given in the chat.
Guys,
Okay.
once you fill the attendance form, you are free to leave. Thank you.
Please fill the attendance form. Once you have filled it in, you can leave. Thanks.